A shadow bank is a non-depository financial institution that's exempt from normal banking regulation. These firms are responsible for creating tens of trillions of dollars in debt and equity capital across the global financial system. Join me as I take the esoteric power of capital creation from behind the closed doors of Wall Street to your Main Street. I'm Ben Summers, and welcome to the Shadow Banker's Secrets podcast, based on the book I wrote by the same name. Today, we're joined by Nirav Desai. Nirav is an engineer by education and the founder of Kubera Wealth, a rare, data-driven RIA. Nirav, good to see you.
Good to see you too. Thanks for having me.
I appreciate that. I mean, we speak quite a bit offline. I think we've established a bit of a rapport, certainly at least the foundation for philosophical alignment with respect to a merit-based approach. Like I tell people all the time, 99% of the financial advisory community is just objectively bad, right? And so when I get the opportunity to speak to someone in that space who is smart, curious, and independently minded, taking ownership of their responsibilities as opposed to just checking a box and being a glorified salesperson, it's a rare and valuable find. And so genuinely happy that we got the chance to cross paths.
Yeah, thank you. I appreciate that.
Yep. So just diving right in, tell me a little bit about your background, right? So you're an engineer by education. You've obviously now evolved into financial advisory. How'd you get where you are?
So I started out in computer engineering, got my graduate degree in computer science at USC. And after I graduated, I started, working in engineering. Along the way, I was investing my money as well. I've always been an avid investor. I started investing when I was 16 years old, and I've been following the market since then. And then all of a sudden, my dad passed away very suddenly. So he died unexpectedly at 63, and just going through his estate and cleaning up all the mess, I realized that despite making good money his entire life as a physician, he never received good advice. The advice he received was completely bad. And the people who he trusted were completely incompetent. And during the process of cleaning up his estate, I realized that the average person doesn't understand or doesn't even know whether or not they can trust the advice they receive. And there isn't really any measure of whether this is good advice or bad advice. And for the longest time, financial advisors were basically just a channel to push product onto clients. And any financial planning that happened was essentially a sales tool to keep pushing product. Essentially, the client's outcome wasn't necessarily the goal here. And for the 17-year period between 1982 and 1999, stocks returned about 17% on average. During this time, if Wall Street was taking 3 or 4%, 5%, then that was fine. There was still a lot left for the investor or the client. But nowadays, when we think expected returns are going to be, mid to high single digits, if Wall Street is going to take 3, 4, 5%, there's really nothing left for the investor after inflation. So definitely, I think there is a lot of room for growth for people that really care about the end user and want to try and create an end user that put, or an end result that puts the client first. And so that's kind of how I started my business, where I developed carpal tunnel syndrome, so I realized that my days as an engineer were over, and I was able to go back to business school full time during the Great Recession, mainly because I'd made enough money investing to kind of support myself through this. And during this process, I realized that even in business school, most people don't get the kind of personal financial advice needed to become successful in their financial life. And after that's kind of how I started my own business. I'm like, you know what, I'll figure it out as I go along. The one thing I've learned from all these years of education is that there really isn't anything you can't figure out. That's pretty much how I started it.
Understood. So where are you now?
So so Cubera Wealth is the name of my company. It's a small boutique firm. I had a partner earlier this year who I bought out. So right now it's just me. Typically, I work with a lot of executives and professionals in tech sector and healthcare space. They're usually around 40s, give or take a few years. They're at that point in their career where they're making good money, but they don't really have a lot of bandwidth to focus on investing. But they realize that they're confused by the current economic landscape, their tax situation, the slew of investment options, and they're also distrustful of major Wall Street firms. And so they're trying to look for somebody they can trust, somebody that will give them unbiased advice, and somebody who they feel is competent enough to do a good job. And so, after working with me for a while, most of them, feel confident that I'll always do a good job. So basically, what I do is I take a look at their overall financial picture. I incorporate the tax aspects of it. Sometimes we'll do some strategic tax planning, and we'll invest their assets in a way that reduces the variance of the outcome. The nature of risk and reward is that sometimes the reward doesn't show up in our time horizon. And so we never want to take on more risk than we can bear. And if we focus on managing the risk, the returns will take care of themselves. And once you do that, you can kind of narrow the variance of the outcomes. And based on that, you can project, what your financial future will look like. And that's basically what we're trying to do here, is basically give them a well-defined, narrow range of outcomes, so they know they basically know where they stand, what their assets are going to look like in the future, and how much money they can spend down over time.
Understood. There are a couple of different questions I want to ask, but they all kind of converge into one idea. So I'll take this tack. You had your undergraduate degree in engineering, and then you went back and got your MBA. Like, as you know, and most everybody knows at this point, I think, we're a rigorously quant-driven firm.
Right.
And the issue I take with modern portfolio theory is that it operates on the assumption that the only market in the world is public markets, where there's more out there, right? And then so all of a sudden, when you move beyond the scope of the S&P, then the idea of, say, the efficient frontier no longer becomes germane. And so, given my perspective, when you pursued your MBA, I assume there were quite a few finance classes mixed in there.
For sure.
How much time was spent on quantitative risk analytics in your academic time?
Very little. Very little. Like I said, I think academia will teach you the basics, and then you actually need to figure out how to put it all together by yourself.
Yeah, I think that's a fair statement. I mean, I would describe academia similarly in that they will give you a box of tools, but they don't necessarily tell you how they should work together, right? Or how they
No,
should necessarily be applied, right?
that's true. Yep.
That's for your slave master employer to use at their discretion, right?
Pretty
Um,
much, pretty
yep.
much. And
Um,
that's one of the things that came out when before I started my own firm, I was talking to alumni and trying to figure out what was the best course forward, whether what kind of firms I should be interviewing at. And of all the people I talked to, every single one of them said, you know what, you should probably start your own company. The last thing you want to do is end up working for somebody else because you're not going to like it. And you're going to be a terrible employee. So it's better off, if you're an independent thinker, that you start your own company and figure out your own route.
yeah, and to be clear, if someone ever told me, and I've been told, that I was or would be a terrible employee, that is unequivocally a compliment. It takes a certain type, it takes almost a lobotomy to be a good employee. You've got to check your brain into the door and just be, yes, sir, right?
Yeah.
And I don't see that the temperament that successfully navigates that environment is necessarily one to aspire to.
I agree. I definitely, I agree.
Yeah. So kind of going back to the risk stuff, you mentioned it quite a bit, right? Obviously, risk governs everything that we do. There's one statement you made that I do take issue with, right? And you said effectively that risk and reward are tied, right? To generate return, effectively, you have to expose yourself to a commensurate level of risk. Now, I don't necessarily agree with that. I do agree with it in the context of public markets because they're efficient.
Right.
But the very nature of arbitrage decouples risk and return. We've talked quite a few times. Nirav, you sent us some data on a portfolio that we analyzed,
Right.
just to try to develop some intuition with respect to some of the risk measures that you may not have been accustomed to using before. I think probably Omega and Modigliani were relatively novel. That's probably a fair statement, right?
Yeah.
And look, I'll tell you, and I tell this all the time. Modigliani is not an end-all be-all. It only measures second-order risk characteristics, but it just does so in a very intuitive way. And it is not dependent upon a benchmark. So, for example, alpha, like most financial, even retail people are familiar with beta and alpha.
Right.
And what that's telling you is your performance relative to an index. It's really just opportunity cost relative to an index. What Modigliani does is you're effectively scaling the Sharpe ratio. And so now you have total second order risk that's benchmark independent, right? So now you can look at Modigliani and it gives you an apples to apples comparison, regardless of what you're looking at. Now, that may be less impactful if you're strictly confined by public markets. But when you leave public markets, when you start, like we've talked about before, utilizing institutional standards, applying them to arbitrage opportunities in private markets, now all of a sudden you have something substantial, unique. You do have a decoupling of risk return. And now Modigliani still holds, because it's not, I mean, you can still use alpha and beta, obviously, but that may not be the most appropriate relative frame by which to construct a measure. So a little bit of a tangent into the weeds on Modigliani. I guess similarly on Omega, second order considerations are limited. Again, they're telling you about volatility. Volatility is not risk. Risk is a little, volatility contributes to risk, but risk, as I say all the time, is the probability of loss weighted by the potential degree of that loss.
Right.
And so what Omega tells you is how do the gains over at least one complete market cycle worth of data, compare relative to the losses, the downside over that again, full market cycle. So now that gives us a full 4-moment picture of where we stand. And now all of a sudden, if we've got expected return, geometric mean of historical performance, drawdown with drawdown duration, which is intuitively obvious.
Mm-hmm.
Now we've got Modigliani, which gives us absolute second order risk. And now we've got Omega that gives us all 4 statistical moments. Now we have a complete picture.
Right. So, to your point about risk and volatility not being the same, but volatility contributing to risk is, if you have a portfolio that's in distribution mode, if you're taking withdrawal from it, a higher or a portfolio with higher expected return, but with higher volatility, is worse than a portfolio with lower volatility and lower expected return, because you could run out of money. Right.
That's true.
In many ways, volatility is the risk of running out of money. And so, especially in a year like this year, 2022, where long-term bonds are, which are typically how you hedge a normal portfolio, they're down 30% or 30 plus percent. If you're hedging your stocks, which are also down 30%, with something that's also down 30%, that didn't provide any hedging at all, right? And so, if you're gonna use something to hedge, you want something that is uncorrelated, which I think is where some of your products might come in, and that's where we what we are exploring.
Sure.
Moving forward, right?
Well, to your point about volatility and again, false assumptions about market participants being rational, was it Keynes who said that the market can stay irrational longer than you can stay solvent, right? And it's true. Like, the yield curve is over 60% inverted. Where's that baked into modern portfolio theory?
Right.
And look, I would never advocate, and disclaimer and boldface, italics, scream from the rooftops. And we can talk about what we expect in the future, but responsible investment decisions are not made by looking into a snake oil salesman's crystal ball. You make decisions based upon what has historically performed best across every type of environment. And I'd argue that is where allocations should be focused. That being said, it's impossible to ignore what is potentially imminent, right? And if you look historically, any time in history when over 60% of the yield curve has been inverted, that is a precursor to much deeper bottoms to come. Right. And so where's the haven? Right? Like, if bonds are going down because the Fed is going to tighten, at least, and they balk as if they're going to do it in perpetuity, we know that's impossible.
Right.
And lockstep with a drop in equities, then where's modern portfolio theory leave you now? Right? Like, my point is that those assumptions, which we identified as obviously false, we're seeing examples of that playing out in real time. But yet most people who don't have the intellectual agility that you have, Nirav, for example, don't recognize that. They don't recognize their entire castle is built on a foundation of sand. Fuck that. It's probably a foundation of clouds. It's just fiction, right? And so they've got no problem with respect to making decisions that fit that paradigm if they lose money, right?
Mm-hmm.
But by no means would they ever say, maybe some of these assumptions are false, and maybe I should look beyond, right? These, I don't want to call them glass walls, but they're not even really walls. They're just they're imaginary boundaries, right? They're just
right. I mean, people are reliant on a framework that if you put 60% in stocks and 40% in bonds, then this is good through thick and thin. And maybe that might be true, but when interest rates are zero, and we know that the Fed is probably going to raise interest rates, 400, 500 basis points, how do you not know that your bond portfolio is going to get decimated? If you were relying on bonds to hedge your portfolio, then you should at least be aware of the fact that that might not happen if the Fed starts raising rates rapidly.
Yep. Yeah, and to that point, like, so I'm of the school that, look, the Fed cannot raise and hold interest rates indefinitely. There are too many low yield assets on institutional balance sheets for the Fed to raise and hold rates indefinitely.
Right.
It's going to bankrupt the entire fucking financial system. Now they're going to hold off as long as they can. They'll probably break it before they acquiesce, but it can't be held forever. So even me, I would be the school of thought to be like, well, the Fed can never really raise rates. It may go up 400 or 500 basis points. And that sounds like a lot. And that is, until you think back to relatively recent history when the Fed funds rate was 21% in 1981, right? That's
right.
Raising interest rates in an inflationary environment, right?
Yeah.
So, but it's going to have to acquiesce. Even me, I would never be the guy who would bet on a secular increasing interest rate environment. Maybe transient, like we've seen this year. Of course, I think the more traditional financial professionals have believed that, without looking beyond their nose, that rates have to go back up. My point is that there is no perspective that I can think of that could justify a belief in bonds being a stalwart safe haven. Because the Fed at least has to balk. And if it balks, you at least can have transit issues. Right. So if you extend the traditional advisor's perspective, one of the hallmarks is that it is characterized by asset class based allocations. And you mentioned this before, just a minute ago, actually. We can begin to talk about other asset classes and you can start rolling them off. Oh, real estate or private equity. But I would argue that that is still a grossly flawed way of thinking, because the way to optimize a portfolio, the way to optimize an allocation decision is by going where the best risk adjusted performance is, regardless of what bucket that lives in. And so an example of that is if you look at the real estate market, for example, like that's the most popular alternative to fucking equities. So we look at the real estate market, right? If you analyze it, it's got a beta of about 0.85, right? Its drawdown is still many years and it's deep double digits on the downside.
Right.
What that means is that market is not too terribly dissimilar from the equities market. Now, the big difference is that when you look at even at the grassroots level, there's more friction in real estate. So movements are slower, but the movements are still there, particularly since 99. And the Fed effectively made real estate an extended traditional asset class when it injected itself into the market by inflating the mortgage market.
Right.
So now real estate is just as susceptible to bubbles as anything else. And again, the data demonstrably shows that there's no such thing as a good market. You're not going to go buy a good market.
Right.
The performance lies in rigorously managed, thoughtful, active management. And I know that is blasphemy to a lot of traditional advisors, right? Most advisors, Tony Robbins, when he decided to become a financial advisor, wrote a book on the subject, right? Index, right? Like it's awful. It's objectively fucking bad, right? And so,
I mean, one thing most people don't realize is that there's no such thing as passive investing, right? Like if you decide to put all of your money in the S&P 500, well, the S&P 500 is an actively managed fund. I mean, index, right? Like they make active decisions based on profitability and size, whether or not to include certain stocks in their index. And nobody just goes out and says, well, let's just buy every single asset class according to its market weighting. That is the only true passive index, but
Sure.
Nobody follows that. They make active decisions every day about how much to include or which stocks to include or what to cut. And these are all active decisions. And so now the only thing is, it's just a matter of degree as to how much active participation you want or involvement do you want in this.
Yeah, I take it one step further. I'd say that and it's a brilliant point, but the direction I would take it is this, is that effectively active management is inescapable. So you better find the best fucking active manager there is. Right?
Yeah.
And I'll be the first one to tell you, because I'm in the alternative space, and I'll tell you, like 19 out of 20 of the alternative asset managers that we see are objectively dog shit, right? Like, it is true that most actively managed strategies are bad. If you look at the hedge fund market for the past decade, it's been kind of fucking abysmal, right? They've been spending a decade trying to bet against the Fed, right?
Right.
So, and I think it sounds kind of mean, but most people don't exercise the intellectual rigor to differentiate based upon nuance, right? And what I mean by that is, it can be true that most active managers are bad. It can also be true that the only place to find good investments is within active management, right? And I think a lot of people have a hard time reconciling those two ideas simultaneously. And to your point, they're doing it anyway, right? If you index, you're buying a form of active management.
Yep.
So on our side, what we're doing, and like we've talked about before, is we are genuinely asset class agnostic. We don't care if it's a algorithmic long short guy. We don't care if it's a real estate guy. We don't care if it's private equity. We don't care if it's synthetic risk transfer. What governs our decisions in terms of which asset managers we select, how we optimize their strategy, is simply, what does their accurately measured performance dictate? And now, when you've got a handful of these guys, the next topic of diversification comes up. And I say this fairly often, there's not much that Warren Buffett says that I put weight in. But there is one thing he said that I do, and that's diversification is effectively insurance for ignorance.
Correct.
It's insurance for not knowing what you're doing, right?
Right.
And you may have seen this in engineering. I've certainly saw it in physics, right? Like thermodynamics. Like that's a statistical measure of a mechanical system, right? When you know what the individual constituents of a system are doing, you can use Newtonian mechanics to describe it, right? When you're dealing with a whole bunch of them, well, we'll just take a statistical average, and that's temperature, right? So the same applies here. I mean, and it's, again, people might, especially financial people, might want to push back and be like, oh, that's just an opinion. No, fuck you. That's objective fact, right? That is science. And the same holds here. Like, and it's true that if you're dealing in public markets for which 80% of all price movement is attributable to noise, Meaning
Right.
that the best you can do, no matter how smart you are, how complex your algorithm is, the best you're ever going to do is tease out a 20% signal to noise ratio in the market. So if that's the case, then I get it. You got to diversify because it's impossible to know what the fuck is going on by definition. But when you take a more strategic approach, when you're operating at what you might describe as the grassroots or the granular level, which a lot of alternative asset managers have the ability to do by the virtue of how they allocate, right?
Mm-hmm. Yeah.
Now it's not a matter of I'm going to buy every property in this zip code. You're going to buy the two best.
Right.
Right.
Yep.
So what's a better portfolio? A real estate guy who picked the two best properties in the zip code, or somebody who bought the best zip code? Well, Fenrir would tell you the guy who bought the whole zip code's better because he's more diversified. Right.
Right.
So, and this is a paradigm that a lot of people have a hard time recognizing. And I think it's why that you and I have been able to have ongoing conversations and are making substantial progress and working together. It's because you do have the intellectual wherewithal to recognize these relatively abstract ideas. Granted, they're not rocket science, but holy cow, it doesn't take rocket science to throw people off these days. So anyway, that's where we're moving to. And for the purposes of our audience, right? Like, to be fair, the overwhelming majority of them have a very negative perception of retail financial advisory, and for a good reason, for many of the reasons that we've already talked about, right?
Right. Yep.
And so, God love them, a lot of them have just said, well, what else can I do? And a lot have just gone into buying real estate. And they've done worse than they potentially would have done if they just bought the S&P, right? Because like real estate is an actively managed business, right? It's not, there's nothing passive about it at all, right? And so they haven't done well. Then all of us also, this is compounded by the fact that the real estate market itself has become somewhat cyclical over the past couple of decades. So now it's just another bubbling asset class. A lot of the people in our ecosystem don't have confidence in anything third party, right? They want to do things themselves. And what inspired them to engage us is that they may not have understood the math, but they understood our track record, particularly in terms of drawdown and average returns, right? And that was compelling. And now that's effectively the gateway to get them to begin to say, all right, there's more to it than just drawdown and expected return. Now we can look at these other measures and have a complete, accurate, comprehensive picture that allows you to position yourself not in a unilateral way. And what I mean by unilateral way is, again, most advisors will be like, okay, we're approaching a bear market. Now we need to take a defensive position. Oh, now I think we're going into a bull market, and so we should take a more aggressive position. Where our paradigm and thesis dictates that you can't predict the future, and so therefore you do not allocate based upon what you guess the future is going to do. You allocate based upon the boundary conditions of what you have seen historically, particularly driven by the downside exposure, such that if you are positioned to be protected from the downside, then the upside will take care of itself. And it's a very different perspective that is, again, uniquely available, particularly in private markets. So some context for this conversation is that, of course, we're an investment bank. We've got hundreds of thousands, over 1 million high net worth retail investors in our ecosystem that we've just really not served for far too long. And it's just too much to ignore. So now we've decided over the last few months to partner with, somewhat arbitrarily, admittedly, 10 retail advisors to refer them to, so that we can create a win-win scenario where we can find advisors who represent an extension of our perspective, who can provide these investors the same approach that we would have if they had the wherewithal to engage with us directly. And so that process is first predicated on establishing, is there the intellectual wherewithal, curiosity, and independent thinking, which is obviously the case.
Right.
And then we progress to, all right, can we meet, and this is the non-negotiable, right? Can we establish a tight alignment of philosophy, which means that your portfolio construction decisions are predicated on exclusively what the accurately measured risk-adjusted performance dictates, in lieu of the parameters, the modern portfolio theory parameters that you and other financial advisors have traditionally relied upon. And so at this point, what we've done is obviously, like I mentioned, Nirav has provided us data on one of his portfolios. Again, not to necessarily evaluate, but just to establish some intuition, to provide a concrete example of what these relatively abstract measures mean. And then from there, the next step is to go through the appetite of your client base, and we're not there yet, right?
Yeah.
But to determine what specifically are they looking to achieve, and primarily, or the primary criterion that governs how we would construct portfolios for you is liquidity. Because, and what I mean, liquidity is the decision between growth and income. Liquidity is obviously lockup, right?
Yeah.
Because beyond that, what we do to construct a portfolio is take the highest performing asset managers we have and develop that portfolio with only those asset managers, insofar as they do not violate the liquidity mandate of the allocator. In this case, it would be your fund of funds, which we can talk about, right? Yeah. So when we say diversified, it might be diversified across 3 to 5 asset managers. We're not talking about 50 funds, right? Could we put 50 funds in there? Yes. But why would we buy the whole zip code is the point. We don't go any deeper into the bullpen of asset managers than we have to accommodate the liquidity mandate of the allocator that we're accommodating. In this case, again, on the advisor front, now the allocator is their fund of funds, because obviously we began to talk about alternatives. We didn't talk about necessarily the vehicle here. We're talking about, it's not just the strategy, like these strategies that have proven to be robust, anti-fragile even, against market bottoms while still performing well in normal and good times. But we're also talking about the vehicle that wraps them, the operational infrastructure that makes them a responsible and reliable steward of money, right? So when you combine the private market constraints, when you combine the operational standards, now all of a sudden you're constructing institutional grade funds, which have very high minimums. You're talking 7-figure minimums, which is beyond the reach of an individual retail investor. So now what happens is we have the advisor, instead of having one investor or one client allocate to a fund that's got 7 figures, which is probably not prudent, right? Now the entire client base can have their entire portfolios. Now the entire client base can have their entire alternatives portfolio aggregated into one fund. Now that becomes the allocator, and then we can construct that portfolio. We've gone through, again, this typical portfolio that you sent us. We went through that. That was a helpful step in the process. I believe, I'm not mistaken, that one thing that you were working on is compliance on a fund of funds. Is that correct?
Correct. Yeah. So one of the things the compliance people told me, I have a meeting set up with somebody senior, but the junior person I spoke to, he basically said, yeah, the reason we don't recommend it is because that puts you in line for an annual audit, and that the compliance of that is prohibitively costly. And so it's just easier to approach once you're SEC registered. So it's not that they didn't want me to do it. It's just that it usually isn't cost effective unless you, are going to achieve substantial scale on this.
Yeah. And
process.
And that's precisely the point of doing it. So, but point taken, like we've got to get there first, right?
Right. Yeah.
And so, so with respect to the audit, right?
Mhm.
By virtue of your current AUM, you're state registered.
Correct.
You're not, right?
Yeah.
Now, I have never been a state registered RIA, so I don't really know what that looks like. So this could be helpful, right, for the state registered folks out there.
Yeah.
Everything. I think you and I had this conversation before. Maybe I don't think it was anybody else. I think it was you, right? Where for me, I've always been looking at the federal thresholds, right?
Mhm.
So whether you're a retail facing RIA that's just doing a traditional, running a traditional business model, you're looking at about $100 million, various thresholds where you'll federally register. If you're a fund manager, you federally register at 150 million, right?
Right.
If you're just managing a fund. So if you've got over $100 million in management, you're getting audited anyway. What's the fucking difference, right?
Exactly. Yeah.
So, but when you're dealing with smaller AUM, state registered stuff, I guess the first question is, are you being audited annually currently?
No.
Okay.
I haven't been audited in 6 years.
Okay. So then the next question I would have is, I'd say once your AUM in the fund has exceeded $150 million, right?
Mhm.
This becomes a moot point anyway, right?
Right.
The audit can easily be covered. So as long as your fund AUM is below 150, and as long as you're state registered on the sort of traditional SMA side, where did your compliance counsel see that an audit came in?
So in California, I think the way they explained it to me was that if you're running a fund of funds or a feeder fund, you do get audited, and you basically need a higher level of compliance because of essentially because of California.
A couple of the non-negotiables in running a legitimate fund, right? Just beginning to enter the institutional space is you've got third-party administration and you got annual audits, right? And ideally monthly valuations. Now, not a lot of institutional folks will bypass that by buying private equity that's closed-ended, and they will just they'll not bother with the monthly valuations. They won't mark to market. They'll just be like, it's a closed-end fund, and what it is, it is. We don't operate that way. But yeah, the audit is, I'd say it's a non-negotiable, regardless of what sort of regulatory imposition you may face. Of course, the assumption is that the AUM is going to clearly offset that, and it shouldn't take a whole lot of time to do it. But I certainly get your point. To what extent would your current compliance team or firm be involved in that audit process, if any?
I don't think that they would be involved in it. I think a lot of it, or rather, they can assist with the compliance portion of it. But I think it was, mainly they wanted me to be aware of the fact that it was going to be expensive in terms of time and cost on my end.
Sure.
And compared to the current requirements, I think it has an expanded scope. And so they wanted me to be aware of that.
Understood.
And so I still haven't gotten a good ballpark of what this entails in terms of time or cost. Mm-hmm. So I do have another meeting set up next month with them.
Very good.
To learn more, but I have a feeling this will cost somewhere between $25,000 and $50,000 a year for the compliance and auditing and third-party administration.
Yeah, all of that together.
Yeah.
Yeah, that's probably a fair estimate. That's probably a fair estimate, right? So,
Okay.
certainly that needs to be taken into account. And that reminds me, that's where we're at. We're still waiting for you to get the answer from your compliance team, right? To tell us what kind of AUM you need to be able to justify the effort, right?
Right. So what is your experience? How has your experience been? How long does it take for somebody in my position to ramp up? So what could I potentially expect?
I think 5 million a month is a realistic expectation for the minimum AUM growth. And I mean, to be fair, it is a little bit of an audition. I don't want to sound like a dickhead saying that, right? But like, say we send 1,000 people, and I'm going to leave Carlos out, to 9 other RIAs and thousands of decent sample size, and one person's closing them and somebody else is not. That's certainly going to affect how we, right? Or people report back that, hey, Nirav was awesome, but what's his name? Not Carlos, whatever, Ed. Yeah, Ed was a dickhead. Then we're not going to send people a dick. So, right, it's not there. There is a necessary component of ongoing performance. And what I mean by that, it's is the messaging still congruent? Are these people maintaining confidence with the handoff? Because I can tell you, I can think of another fund of funds where the fund manager is congruent in messaging, but his personality does not instill confidence, right? It's just, you know what I mean? It doesn't, right? And so really nice guy, really good guy, but he just doesn't get people across the finish line because it's not in his nature, right? So all that being said, and I'm factoring in my assessment of your presence, your personality, your intelligence, all of these sorts of things. I'd say 5 million a month would probably be the expected minimum.
Okay.
Now, the expected returns, and again, to be clear, when we're working with financial advisors like yourself, I say this a lot, and I don't think I can say it too many times. There's no obligation for your fund of funds to allocate to our stuff. The obligation is to allocate to what is objectively best. So if you've got access to stuff that's better than us, then congratulations, we're happy for you. We just know that we're going to represent a substantial percentage of that portfolio just by the nature of how that industry works and where we sit in it. We need to know that the relationships that we have with the retail investors, the potential clients in our ecosystem, are being served consistently with the standard that we've established through our communication with them. And that message is delivered with conviction. And that's why the first step in the process is to analyze this portfolio, right? So to attempt to establish some visceral tie to these numbers. So you can be, I mean, I'm not saying you've got to be as evangelical as me about it, but like, it's obvious that you mean it, right? Because people have an innate bullshit meter. They can tell when a financial advisor is reading the boilerplate versus when they're talking to somebody who really understands, gets, and is convicted in what they're doing. And that comes across. So all of these things come into play. So what would it take to offset the costs of running your fund of funds without impeding the performance for your investors, right? So the stuff we're looking at, generally expected returns around 20%-ish. So if you're looking at a 20% annual return on, say, 5 times 12, $60 million. Let's round it down. Let's call it $50 million right at the end of the year. Now we're looking at $10 million in gain. A $50,000 audit can be easily covered there, right?
Right.
If it was 10% of that, or 20% of that, so say, we're down to $1 million a month and now, or less, call it $10 million at the end of the year. We're still $2 million in gains. Yeah, that it can support that $50,000 audit. So I understand, given the traditional model where your fee structure is 1% and you're working with, say, $30 million AUM, but in the context with marginal performance, and at this point, thematically descending performance across everything, right?
Right.
I understand the reservation with respect to, a 5-figure, expense. But what we're talking about here, that expense evaporates with relatively very low AUM, right?
Right.
And I think, at least based upon the examples in this conversation, I think it becomes a little bit more clear. So even, say it's a $1 million allocation. Let's pretend, let's use your numbers. You got $30 million, right? Let's say half of that's a credit. That's $15 million. Let's say, just to, start to kick the first horse, you've got $1.5 million in this fund of funds.
Okay.
Let's pretend that's the case.
Mm-hmm.
So now we're looking at $300,000 return at the end of the year. Even that supports the $50,000 audit, especially relative to everything else that you're fucking up against, right?
Right.
So, I mean, I'm actually just doing this math. I mean, it's math I've probably done 15 times, but I'm thinking in a fucking vacuum right now. So, and I'm glad to walk through it with you here. Even at your existing AUM, if it did not grow a fucking penny with 15 to 20% performance, right? Which you've heard us talk about GP stakes. In that case, you're just buying goddamn fees, right? Like even you're getting paid your fees with the market taking a shit, right? As moral and ethical and as well-intentioned as you are, you're still getting fucking paid when your clients aren't. That's the point, right? So when this GP stakes fund, the capacity on that, like, I mean, it could, that alone could, we're talking about $50 million divided against across 10 RIAs, $5 million a pop, right? 1.5 is a drop of the bucket in this fucking thing. So that's not, you're not going to saturate your position of the fucking GP stakes fund there. Like, that's effectively 100% annual goddamn yield. You could put 500 grand into that shit and still afford the expenses on the audit at the end of the year, right? So I think the issue, and to your point, is less about the expenses in a vacuum, because as I always say, expenses in a vacuum don't mean anything. It's like looking at the price tag in a black box. What's in the fucking black box, right?
Right.
Now, if you are, you're incurring a $50,000 a year, overhead increase by virtue of running this fund of funds, but you're up 15, 20% in a highly deflationary market. Is really anybody going to question those fucking fees? Expensive, not even fees. No. They're expensive. They're not going to fucking, they're going to thank you for those fucking fees. That's the point, right?
Yeah.
And it's a misnomer. It's not fees. It's expenses. Yeah.
So are these expenses, are they deducted from the fund itself?
Yeah. So
how are those typically handled?
So a fund is a self-contained business. All of the expenses required to set up the fund, to maintain the fund, to manage the fund, to run the fund are all covered by the fund itself. It's all internal. So when fund performance is reported, it's net of fees. Well, not always, but it's certainly net of expenses, right? Now, sometimes people like to report fund performance pre-fees, which I'd argue is fucking unethical, because nobody gives a shit about what their returns are before you charge them. They record, like, what's the cost after tax, right?
Right.
So, and that's what we always underwrite with our asset managers, and that's what we'd insist that you communicate to your clients. So everything is self-absorbed. So the question about the expenses, where the formation, because formation is also going to be 20 to 50 grand, right?
Right.
So call it 100 grand all in to start up, and run the fund for a year. Oh my God, that's a lot. Well, it's a lot if you're making negative 20% fucking returns and you've got $1.5 million in AUM.
Right.
It's not a lot if over the course of a year, your rolling average AUM is 25 million and you've generated 20% on that. Now that 100,000 means nothing. So that's precisely why we exist in the market, right? Like if I was here selling some shitty fucking dimensional fund, like, hey, it's got our logo on it, so buy it because you have to, because it's ours. But like, we're just saying, here's the best stuff you can fucking have. And remember, there's no obligation. We're not pressuring you to allocate to our shit. We're telling you, you allocate to what's best. This is ours. If you have better, show it to us. We'll congratulate you and be genuinely fucking happy for you and probably go recruit that asset manager ourselves, right? But if we win, you're welcome. Oh, by the way, not only, it's not just the fees, it's also you get, potentially 2 and 20 on that. Now, Carl, my colleague, doesn't like that. He thinks fund-to-fund guys should only get paid 1 and 10. I tell him, that's not my fucking business, right? That's your business between you and your clients. And when you see the performance, right?
Yeah.
I think you'll quickly see that your clients will be happy to pay 2 and 20 plus $100,000 a year in fees, expenses, right? To make a net 10, 15% returns, right? And when I'm saying a net 10, 15%, that's if we had a full $300 million alternatives portfolio together for you, close to $600 million alternatives portfolio for you. And now you've got what we describe as LP positions in these strategies. But your first 1.5 is going straight to fucking GP stakes. You're buying fees.
So why do people sell GP stakes?
I just wrote an article on that, was published in Forbes on Friday. So lots of reasons. Contrary to the heuristic amongst financial professionals, AUM is not an indication of low risk. It's actually inversely related. And what we find invariably is that the best asset managers are the best asset managers because that's what they fucking do. They've got a brilliant strategy. They've got a brilliant niche within a market. They've got something brilliant about what they do. Let me tell you what they're not. They're not fucking bullshit artists, right? So raising money, generally speaking, for almost everyone else is the domain of bullshit artistry. That's not their fucking expertise. So what they've done is they have tapped out their friends and family, right? So they may have gotten to 10 million AUM, 80 million AUM, 200. Don't know, don't care. It's individual specific. But what matters is they're way, 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 way below their relative saturation, but they have no way of accessing the capital markets otherwise. Their friends and family are fucking tapped, right? So like, yeah, I'll give up half my fees to grow my AUM by a factor of fucking 10. That's why they do it. Because it's the only means they have of growing their AUM. And then also, may not be obvious is that we don't engage asset managers like traditional private equity engages a portfolio company. Like private equity is traditionally characterized by assholes and rapists who want to go in and just steal every penny they can from the portfolio company just because they have the financial leverage to do so. Right. Morale is a thing. So when we work with our asset managers, this is a relationship in perpetuity. Like goodwill means more than just a line item on the balance sheet. Like we need them to be happy about working with us. And so while they are giving up half their fees, they're not giving up anything relative to what they would be if they went to, say, a hedge fund incubator, right? Or if they went to fucking Blackstone. Not that Blackstone would even talk to them, but if they could, because you got to have these threshold AUM, right? If they went to Blackstone, Blackstone would rape them. Like giving up half their fees would look like nothing compared, like Blackstone take it all, right?
Yeah.
So everything's relative, especially in finance. And so by virtue that we're transparent, but when I say the GP stakes is taking half their fees, that's not entirely accurate. The GP stakes is taking 1 in 10. So if it's a traditional hedge fund, it's a 2 in 20 structure because the performance is fucking great, or private equity, because the hedge fund stuff is really just marginal because they're constrained by public markets. I think I've said that many times. Most sophisticated guys we have are public equities. The worst performing are public equities. But particularly private equity, also 2 in 20 reference there. In many cases, these private asset managers are not just sitting behind a Bloomberg trading, or it's not just a matter of recruiting a company and buying it. They may have a more operationally laden business, right? I don't like this example because it's typically shitty, but one example might be like, let's just say it's real estate because that's what people are familiar with. It's not going to be, but let's say this, right? Okay. So real estate, there's a lot of work involved with actually going out and finding the property, right, investigating its financial and physical condition, understanding the nuance of its market, because its market is not the geographic area. Its market is a comparable property in the geographic area, which is a different fucking thing, right? Right. Managing the damn thing, both from an asset management perspective and from a property management perspective. Like, this is a labor-intensive business. So what these guys are getting paid is not just 2 in 20. They're making some profit on their property management side, right? They're getting paid on the disposition. They're getting paid on the acquisition. They're getting paid in an ongoing management. So their carry might be 30%, not 20%. And so if you look at that shit in a vacuum, like, oh my God, I'd never invest something like that. It's too fee heavy. Yeah, but when you look at the performance of those fucking fees, it's 35%, right? Right. So, but in that case, let's say that was an example. It was a real estate strategy where they're actually charging more than 2 in 20, because of course the management fee is really just overhead and salaries, where these salaries are also getting paid through other ancillary services. Real estate brokerage might be a component of it, for example, as well, right? So the overall expenses and fees may be more than 2 in 20, but yeah, the GP stakes fund is still taking 1 in 10. So something like that is still fucking thrilled, right? Again, not the best example because those guys are not generally the best performing, but it's the most intuitive with respect to describing how the fee structure may not be a 50-50 split. The GP stakes is getting that 1 in 10, right? And it's the senior 1 in 10. So they get paid before where everybody else does. But again, when you're managing money, your fees get paid no matter what the fucking market's doing. Right. And if you're just buying those fees, where's the volatility going to come from? It's hard to fucking manufacture volatility, right? Yeah. So now, granted, the capacity on that is small. GP stakes are limited inherently because you've got to have the asset managers who are A, good enough, and B, are in a financial position to be willing to give up half their fucking fees, right? Right. So it's not like, the healthcare private equity guys where we can go allocate $1 gajillion in that shit. We got 50 million. So it's a win-win all the way around. It's finite capacity. It's a nice gift to the RIAs that we're working with. And it's also a good reputation builder because we're giving you the best shit we got out of the gate, right? Right. So now it's kind of like a gateway drug. And I'm telling you, the GP stakes is going to be way better than everything else because everything else is relying upon the strategy. Now, the strategies are awesome, relatively speaking, but the other stuff that's going to fill out the $600 million, that's LP positions in a strategy. And granted, they're underwritten against 2008, the worst case scenarios, but you're still riding that strategy, right? Which makes them inherently riskier than just, hey, I'm going to buy your fucking salary, right? Yeah. Makes sense?
Yeah, that makes sense.
Yeah. What moving forward would you require, and can you even identify it, that would make you say, yeah, this expense coming up at the end of the year is a no-brainer. It's worth it. What would it take?
I'd like to see what the fund opportunities look like.
Sure.
I don't know if you can share a lot, but the more you can share, the better.
Yeah.
And then once we go down that route, I also need to talk to my compliance people. I want to talk to a couple of other people that will likely be doing the fund administration. Make sure I understand what it entails on their end, what their expectations are from me. Because there are a couple of moving parameters here.
Of course.
And then once I get comfortable with that, understanding the fee, kind of nailing down the fee structure on the fund of fund side, so that there are no surprises later on. Like if I like to do my homework beforehand, so there are no surprises later on.
As you should. That's how to do it.
And so the only surprises we want are to the upside. Right?
Yep. Understood.
So and then I think after that I'll be more comfortable. And then when I create a fund of various different strategies, when we get new investors into the fund, the fund administrator will handle all of the administration.
Yeah.
Right? So
generally speaking, the fund manager has the prerogative of valuations, right? So, but that's not so important for you. Let's pretend that your fund of funds was all. If your fund of funds was all of our stuff, that's simple. We provide the valuations for all the stuff, right? And now you just sum up pro rata what the constituents are of that fund of funds. If you had other stuff in there that wasn't ours, then you would just get the valuations from them. So it's not like you're responsible for grassroots valuations. Like when you buy a mutual fund, you have to value the underlying fucking stocks. The mutual fund is right.
Right.
So it's the same principle here. And so it takes a lot of heavy lifting off on your side. And so we would effectively report those valuations. You'd pass those along to the admin. Probably want to submit quarterly reporting to investors so that the admin would set up the GL and handle all of the quarterly reporting. And then you'd make sure that the auditor and the admin valuation protocols dovetail, so there's no step change disconnect between the valuations that are coming through the admin reports and what the auditor does. But that's largely just a function of picking an auditor that is familiar with what's going on. But yeah, so the admin sets up the GL, they handle the reporting. They basically take your valuations. They'll check. They're kind of like a referee. Like if you're doing something that violates GAAP or some shit, which again is not really relevant on the fund of funds side. It's way simpler. They just want to make sure there's no expectation that the audit will deviate from what you're reporting. They'll handle treasury accounts if you'd like them to. That's what normally happens, right? Well, they'll handle the movement of monies and payment of expenses and stuff. Again, I don't want to say investor relations because they're not comprehensive investor relations, but they definitely handle document interface.
Okay.
Right.
And then they in terms of the performance reporting, how does that work?
So they'd produce a quarterly report is what I would recommend, right?
Okay.
So they can provide an abbreviated monthly statement. And the reason you'd want to have a monthly statement is because you need a valuation to take in equity investors, and it's going to be repriced every month based upon the mark-to-market value.
Right.
But that doesn't have to be a formal report. The formal report is generally a quarterly thing. Just like the audits, the reports and audits are analogous to the 10Qs and the 10Ks on the public side, right? Why I laugh about, private funds are not transparent. Oh, they're more fucking transparent than 10Q and 10K was. I fucking promise. Ask me how I know. Anyway, but yeah, you definitely want to get monthly valuations. That's it. So the monthly valuation is analogous to the ticker price, right?
Yeah.
But instead of being second by second, it's month by month.
Right.
So does that answer the
Yeah. And
question?
then what are the liquidity constraints on these funds?
So we can design it again for our stuff. I can't speak for anything else, but the stuff we design, we issue the range is from 1 month lockups to 10-year lockups. And now I think I mentioned this before. I mentioned to almost everybody, right? One of the challenges with retail investors, and this will include the people that we send to you, right?
Yeah.
They'll say that, hey, my horizon's 5 years. And they'll get back to you in 6 months and say, hey, I want to buy a fucking boat.
Yep.
So need to the cash reserve component is going to be higher on retail than it would institutional.
Okay.
But you are 100% protected legally, right? Like, you motherfucker told me that your horizon was 36 months. And so I put you in the best stuff possible for 36 months. If you told me you had an 18-month horizon, you'd been something else, right? And so, I mean, you can have that conversation in more diplomatic terms than I would have it, but we keep a little extra liquidity to prepare for the fickle nature of retail people, right?
Right.
Yeah. But the lockup, and so when it comes to choosing the asset managers, like ideally, if there are no expense or time constraints, every one of your investors would have their own fund of funds, right? They wouldn't even be a fund of funds, they'd have their own, but we've got to create kind of a max min problem, right? How many variations of the appetite are worth addressing given the economics of doing this stuff, right? And so for you, obviously that's taxing, right? When you got $1 billion under management, we can talk about building 10 of them, right? But for now, it's one. And so you'd want to address the least common denominator in that regard. So like the shortest lockup. Now, what I tell all of them, and I will never want to talk to your people, but one thing that can be come down from the fucking ivory tower and yell at your people who were my people would be if they come at us with a redemption notice of less than 24 months. Fuck you. That is a huge line of demarcation, because less than 24 months is is money markets, right? Like, we need to know which markets we're participating in, right? And so I would never, ever construct a capital markets portfolio with a lockup of less than 24 months. So now the question becomes, do we need 24 months or are we patient money where 10 years is fine, right? And whatever it is, we just design it accordingly. And what does that mean, design? It means how far down the bullpen do we go, right, to get the liquidity we need? Do we have to pull in long, short guys whose performance might be marginal just to buy down the liquidity, right?
Okay.
That makes sense?
Yeah. And so is this something that you would help construct?
We do the whole thing. Like I tell advisors, because some of them already have some alternatives, right? Like, they've got a private equity fund or something, or like Ed this morning, he's got his own fucking ETF. That's pretty good. Still public, but it's not bad. So if they've got their own stuff, we can just take our palette of products and we can just plug a product or two in to fill a hole in performance, which is what we normally do on the institutional side anyway, right? It's like, oh, what one particular performance hole do you have? And then we'll fill it with something.
Okay.
Or if you said, fuck, I got nothing except a good sales pitch, then we could be the money manager, right? We do the whole fucking thing, right? So don't care, just whatever you need and want, right?
Okay.
Again, the only obligation is that you allocate to the best shit, whatever that is, available. Right?
Yeah.
Yep.
Okay, that makes sense. And then are you guys on any other kind of platforms? Are your products on other platforms? Are they only available through you?
They're only available through us.
Okay.
We're actually considering a quasi-traditional thing. Because one thing we uncovered, particularly constructing theoretical track records with private equity guys, because that's tough, is some of them, they themselves don't have a great strategy. but the research and constructing the theoretical track record uncovered relative holes in public markets, particularly segments of the Russell microcap, right? And I verified this. Carl, my colleague, knows this. He ran a hedge fund incubator for a long time. He talked to colleagues up and some of the other firms like fucking Blackstone, where they're incubating smaller funds and they're dealing with hedge fund guys. And I didn't know any better. I just assumed everybody did this kind of work. They don't. Like, apparently nobody goes into the fucking Russell microcap and cherry picks fucking individual stocks. I didn't know that, but they don't. And so that's an example of a public market play that actually has pretty fucking good risk-adjusted performance. I mean, it's not going to compete with the real legit private equity guys. It's not going to compete with synthetic risk transfer, but it's way better than fucking long short equity guys, right? And apparently the opportunity lies in the fact that asset manager traders don't make that kind of fucking effort on an individual fundamental analysis of, say, Russell microcap companies, right? I didn't know people didn't do that. They don't, right? So there are some holes. There are some holes. And so we're looking at taking some of those things where it's conducive, putting them in like ETFs or our own mutual funds. And then that stuff will eventually be brokered through broker dealers. But the thing is, when you go through the IBD space, the only thing they sell is traditional shit, right? So unless you can package your stuff as like some traditional shit that performs like shit, those platforms are just not compatible at all. And I can go off on a whole rant and lecture on due diligence officers at broker dealers and how shockingly fucking incompetent they are. It's the worst combination of a lack of moral development and laziness you'll ever fucking see. It's like a fucking 4-year-old. You've never seen such levels of drive motivated by carrot and stick and the most primitive fucking levels. And these guys are supposed to be fucking the gatekeepers, right? They're fucking kids who don't want to do any work. They don't even do the work on their goddamn job description, much less anything beyond it, right? So no. We're typically not compatible at all with the overwhelming majority of the broker-dealer space. But to your point, I mean, it's a big market, impossible to ignore, and we are starting to see some opportunities to create products that are compatible with that space. Okay. But it's still not the best stuff. It's still not the best stuff. Yeah.
I mean, I was interested in a little bit learning more about your real estate investment experience.
I'll tell you about that. I like talking about that.
Okay, let's talk about that for a few minutes.
I think, as you know, like my background, like you, is not finance, it's physics. And I was in oil and gas, and it was anti-intellectual. And so, to your point, I found myself in real estate. What made me different than everybody else, it's still not obvious to me even. But I would describe it this way. I got into real estate literally by means of Carlton Sheets' No Money Down course. I shit you not.
I remember that.
Yep. And I'll tell you that course is gold. There are topics in there that to this day, like, I'll develop a new strategy and it was fucking referenced in that fucking course. I swear to God, rehypothecation of debt, these types of things. That was in this fucking real estate course. Anyway, long story short, so I was like, all right, I'm going to be a real estate investor. I started looking for good deals. There weren't many, hardly any, right? This is like 2004, 2005, really. There weren't any. And I think most people in real estate were like, well, I just buy what I can. Where I think I was a little bit more disciplined and said, like, if I put my money in this shit, I'm going to be fucked, right? So I didn't do it. And I always like working with my brain more than like working with my hands. I think a lot of real estate people are contractors that rather like beat a fucking hammer than they would like think.
Right. Yeah.
And so I was like, well, that was part of it. And then I found this hard money lender thing. Are you familiar with hard money lenders?
Yes.
Yeah.
I actually took out a hard money loan to rehab my own home.
Yep. I think everybody's familiar with them now. Nobody was 17 years ago, right? Like you couldn't find them. But there was some property I was looking at that traditional financing wouldn't work. And I was like, all right, somebody mentioned hard money and I looked into it and they quoted me their fucking terms. I was like, are you kidding?
What were their terms?
At that point, the effective APR was like 18%. And the maximum LTV was 65%.
Okay.
So they're making 18% a year on the money. If I default, they get the property back.
Right.
33% discount. If you run the inverse, that's a 50% return, right? If they resell at market, right?
Yeah.
So they get 18% if I don't, if I just pay it. They can get close to 50% if I don't. I heard of hedge funds at the time. It's like, these motherfuckers are doing the most incredible mental gymnastics and bragging about fucking 10% that still has a drawdown. These fucking lenders here, right? It's an internal hedge. It's the perfect internal hedge. I knew nothing about finance at that point, but I knew like that's where it's at, right?
They make more money if you default.
But even if they make close to 20% no matter what. No matter what. And the reason they got in trouble in 2008, a lot of them is because they were over levered and they got too aggressive. But anyway, so I was like, that's where I need to be. And so, but to raise money as a lender, to run a lending business, that's much more capital intensive. What attracted me to real estate to begin with was the fact that I was coming out of a job. I had money, but like real estate provided a lot of leverage, especially at that time, right? So the startup capital requirements were low.
Right.
Now, if you're going to go in the lending business, it's the opposite. This is a highly capital. It's like, I need to raise money. Unlike everybody else in real estate, it dawned on me that, wait a minute, there's already an established industry for raising money. It's called fucking finance, right? So I just learned finance, right? And what I saw quickly is that, especially relative to energy, certainly compared to real estate, is that finance people were super sophisticated. So when I started out, I went humbly with a pretty basic hard money lending strategy to my New York friends, and they were condescending as fuck, right? Like, and I was humble. I was like, look, I know this. This is true. I don't know what you know, but you know what you know. I know what I know. Together, we've got gold. And they were more interested in making fun of me for not wearing the right clothes to the party than they were evaluating the merits of what I brought to them. I don't think they believed that hard money lending people existed. Like, it just seemed too good to be true to them, right? Like, it didn't seem like it could be possibly a real thing because all they knew was fucking Sally Mae and Freddie Mac, right? So pretty quickly, I saw that my pitch had to improve, right? And so I saw charts. So I was like, well, what we're missing in real estate is charts because like everything's fucking pro forma based. And that's when I stumbled across the relationship between owner equivalent rent and the housing price index. I was like, wait a minute, that's a fucking bubble. And I learned enough at that point to say volatility is bad. Bubbles are bad. You want to bet on the stable thing and bet against the volatile thing. And so what made me different is instead of just running a hard money lending fund that was an arbitrary LTV, I looked at the local market. And what I mean by market, it's not just zip code, but comparables to the target properties. And I said, all right, what is the lowest historical gross rent multiplier? Or inversely, what's the highest historical cap rate? That's the bottom. I know if that's my basis and I can control my basis because I'm the fucking lender, right? Then I'm running a risk-free strategy. And that's exactly what it was. So when everybody else, like as the market was bubbling, everybody else's LTV was staying 65. It's even going up. They're going up to like 75% LTV at the time because they were reaching, and I was doing the opposite. I was like, my LTV was effectively going down because I was lending at a fixed multiple to NOI, right? Which is a lower percentage. And I was able to do that particularly because I didn't have a lot of money. I capped out at $35 million, friends and family. That's all I ever had, right? So I could cherry pick. And there were enough people. And and then also all the hard money lenders shared the same brain. Everybody always shares the same fucking brain. So all their underwriting was the same. And a couple of things that they all were, none of them were true asset-based lenders. They were all matrix lenders, which means they didn't know what they were doing. They had some kind of informal hybrid underwriting between, are you credit worthy? Do you have a good resume? Is the asset good? I said, fuck all that. I know how to value the asset. No credit, non-recourse, non-qualifying. No other hard money lender, no other lender was doing that shit. So even though I had a low cap rate, a low LTV, my sort of liberal underwriting allowed me to still get deal flow while all the other hard money lenders were still copying each other's bullshit terms. So I still got deal flow in 2008 and did awesome. Had over 20% returns and 30% returns in 2008, right? Because I was cherry picking. And then 2009, it was like gold because now all the liquidity dried up. All these fucking idiot hard money lenders that are over leveraging, with 80% LTVs in a market that was declining 30%, they're all now insolvent. They couldn't make their fucking payments to their bank. Right. I had all the business I wanted. Didn't have a lot of AUM. So now I cherry picked the best of the best of the best of that. Our returns were 40% in 2009. And so when things started returning back to normal, I could still lend because I had unique underwriting. There were all these hard money guys that survived or came back. They're still doing this matrix bullshit. I was still non-recourse, non-qualifying, right? Which means I could even lend into self-directed IRAs. The other hard money lenders can't do that because all their loans are fucking recourse, right? Yeah. So, and then finally, and ultimately what evolved, this wasn't right away, but after a couple of years, instead of it being a mortgage, I actually wrote reverse repos. So I would take legal title of the property and then I would sell it back at a markup, right? So if they defaulted, I didn't have to fucking foreclose for 2 years in a goddamn judicial foreclosure state. I just tore up the fucking reverse repo, right? Right. And the brilliance is that my first iteration of this, I paid a lot of money to an attorney to draft up these really beautiful, fucking expensive legal docs. But then I realized, wait a minute, because another like lawyer said something like this doesn't look like. It said the state commissions are going to look through that shit and call what you're doing a mortgage. I was like, no, I'd done it yet, but that was a real risk, right? Form over function, function over form, rather. So what I did, and I'm going to pat myself on the back here, is I went to the states that I was operating, and I took their realtor board purchase and sale agreements, their realtor board leases, and I just amended those with a few lines and converted those fucking purchase agreements into options. Nice. And they were too fucking stupid to recognize that it wasn't a straight purchase. Like, it's on our purchase agreement. It's a purchase, right? Even though it was a fucking option. Yeah. And that's how I navigated that shit. So again, there were a couple of things that were unique. Number one, I wasn't willing to just do a deal because I was supposed to do it. I was like, this is going to be bad if I just buy bad deals. Number two was recognizing that finance is the thing you need to know if you want to raise money. Number three, learning it better than everybody else. Number four, being clever with structures, right? Like just finding what's the hole in the market and then do it. And there are plenty of holes and plenty of markets because everybody shares the same fucking brain everywhere. Finance, real estate, and so the challenge is you've got to convince people to do things that are unfamiliar, but the trigger point is just have what they need. So at that time, I'm lending differently, but I got money and you need it, right? Now with RIAs, I'm doing shit differently, but I got money and you need it, right? So like that's how. And what had us rotate ultimately into investment banking is that the capacity constraints on the ABL strategy, because I had to be involved with that shit. Right. And so there was a client came in, that story is in my fucking VSL backstory, whatever. But I was like, well, instead of me having to run strategies, why don't I just, since I've kind of mastered this marketing and sales thing and the AUM stuff, instead of me trading the strategies myself, why don't you just go find the best guys available? And then instead of run the ABL strategy, just do them. And then if I need to fill in gaps with some money here, money there with ABL, I'll do it. Right.
Mhm.
But, and that's how I got to where I am. So
That's a very interesting story.
is it?
I think so. Yeah.
I appreciate that.
You know, early 2000s, graduated, my engineering degree and was working in San Diego. And I wanted to buy a house. And half the people I worked with, they're all engineers, so everybody was smart. But half of them said, "Oh, markets run up too much, wait for a crash." And the other half said, "Real estate never crashes."
Yeah.
And I was like, how do I get completely opposite advice from equally intelligent people? Right. And,
Mhm.
you know, these people aren't stupid. Like everybody
Sure.
has an engineering degree. I mean, you know, they may not be the brightest people, but you know, they had the intelligence and dedication to get through engineering school.
Sure.
And so, yeah, I started doing research into that and what drives real estate markets and pricing and everything. And I realized that prices were going to continue to rise. So I leveraged my income 40 times to speculate in real estate.
That's not safe, but you did well.
Well, you know what they say is if you borrow money from the bank to buy your house and you can't make your payments, you have a problem. But when the bank lends you 40 times your income and you can't make payments, they have a problem.
They have a problem.
Right?
Yeah. Yeah.
So,
Touche.
on the flip side, I realized that, yeah, you know, a small hiccup in real estate prices, I'm going to be wiped out. So I got out early. I got out in 2006.
That was the perfect time to get out. Like
Yeah.
that was the end. That was the beginning of the end, really. It's 2006.
Yep. So I started selling 2006 and then I got out. I'm like, you know what? If you're going to panic, it makes sense to be the first person out the door. So I was like, I'm going to get out and I'm going to travel the world, go to business school, ride out the storm, and then I'll figure out what to do.
And see, I'm glad you shared that because that's a really interesting point just in terms of how real estate would be perceived, right? Because I can see how somebody like yourself would look at, say, a real estate asset manager and say, like, no fucking way. Because number one, you're way smarter than the average real estate guy. And I think you'll also recognize that you benefited from timing outside of your control.
For
right?
sure. 100%.
Right?
Yeah.
And you're going to say, like, this guy's a fucking idiot. He doesn't even know that he's just riding a market. He doesn't know where he's at in the market. Like, there's no fucking way. And there's no way, right? Whereas I was the opposite of that. Like I knew it was the worst time. I was entering at the worst time and had to navigate under the worst circumstances, right? Which certainly informs my default position relative to your default. Now we obviously can move from that, right? Like I was overly optimistic about real estate for a long time until looking for as far as the eye could see, every real estate person's a fucking idiot. I was like, okay, I get it, right? But yeah, our experience certainly colors our beliefs.
Yeah. And now I have two long-term rentals, just two single-family homes in the Midwest, and I have two short-term rentals in wine country in Central California. And I've, this year I probably looked at 60 properties. I put offers on 4, and my offers were rejected. And I'm like, well, this is my underwriting. This is how much I can afford to pay for your property. And if you find somebody dumb enough to pay you what you think it's worth, good luck to you.
Yep, they probably did.
One of them did. The other 3, they pulled it off the market when.
Yeah.
So.
Very good.
Yeah, there are a lot of people in real estate who don't really do any underwriting.
Oh, and everything's pro forma. Everything's pro forma. Everything.
Yeah.
Everything. Nirav, it's great to talk to you as always, and I look forward to continue to work with you.
Yeah, thank you for having me. I'm looking forward to moving the conversation along.